Hi there, and welcome. My name is Nate Crampy, and I'm the Vice President at Summit Investment Advisors. Now, I want to talk a little bit today about the volatility that we've been seeing. After more than 18 months of nearly uninterrupted advances, the U.S. equity market has started to decline last week. Now, with a huge sell-off happening on February 5th, and although it is always difficult to endure these declines when they're occurring, it is important to focus on the underlying fundamentals of the economy and the markets, which are pointing to the potential for continued growth in 2018 and beyond. Now, there are several conditions that help us explain the current sell-off. The biggest factor is that a stronger than expected January jobs report showed rising wage pressure. This has increased the concerns of inflation and the possibility of changes to the monetary policy. Now, certainly employee costs make up a large percentage of business expenses, which are typically passed on to the consumer in the form of higher prices. Inflation can also subtract from the fixed income offered by bonds, causing investors to demand higher yields. And in these instances, the Federal Reserve usually attempts to slow down demand by raising interest rates. So, investors now fear that monetary policymakers will increase rates more than expected in 2018. As the market interest rates start to climb in response to the wage growth concerns, this triggers further selling among some of the crowded trades and also contributes to the overall investor concerns. So further deficit spending measures loom as the federal budget negotiations actually still continue. There was a potential for another government shutdown, and if you look at it, it was shut down for a couple hours on February 8th, but we're back open now. So finally, several leading technology and energy companies reported disappointing profits, I should say. So that also contributed to the otherwise strong earnings season, but it contributed to our weakness. So while market volatility is never pleasant, it is important for you to anticipate and appreciate, I should say, that the market pullbacks are a normal part of investing. And we have not experienced even a 5% drop in the stock market since the Brexit vote back in June 2016. So indeed, the markets have produced a series of record-setting gains recently amid the absence of volatility. But also consider that volatility has historically increased in midterm elections, and the market has a propensity to test a new Fed chair. Now, given these developments, the market weakness may have been overdue, actually. Now, our research continues to expect that the Fed to increase 3 times this year its fund rate. And as a reminder, the interest rates have begun to climb from historical low levels. The benchmark 10-year Treasury yield has only begun to breach our kind of research level, trading around 2.75 to about 3.25%. In addition, the Treasury yield curve has actually steepened by more than 0.2% last week, and this is a sign that investors' confidence in the future growth prospects of the economy. Now, there's also a lack of stress in the credit markets. As always, fixed income now remains a critical part of your diversified portfolio, and it provides liquidity, income, and the ability to help basically mitigate a lot of the risk when the equity markets aren't doing well. Now, investors are encouraged to focus on the many solid fundamentals supporting the economy and profit growth. We're having our outlook for 2018 coming up, and we encourage you to attend. This highlights the transition from monetary policy to fiscal leadership as a powerful tailwind consisting of tax reform, government spending, and also reduced regulation. Now, the combination may support growth in personal consumption, investment, and basically business investments, and it also will enable U.S. GDP to grow and possibly to climb even above 3% in 2018. So global growth also appears strong and is projected to potentially rise 3.7%. Now, as emerging markets continue to benefit from the increased investment and Europe continues to improve. Now, one last thing. We've been all having to have as a reminder that it is a healthy part of the markets to pull back. Now, it's important for you to try to resist the urge to react or let our emotions take hold. Remaining focused on the underlying fundamentals, supporting the economy and the markets, while maintaining a long-term view, is a valuable strategy towards a better position for potential success. As always, I encourage you to contact myself or any other member at Summit Investment Advisors with any questions that you have. Thank you.